Hi, and welcome to Chapter 3, Financial Statements and Ratio Analysis. So in this chapter, our learning goals is basically to understand the Stockholders Report and understand the financial statements, income statement, balance sheet, statement of cash flows that companies prepare and shareholders use to review the performance of a company. We also want to understand how financial analysts use financial ratios and specifically to analyze a company's liquidity and activity. When we talked about activity, we're talking about the activity of the assets and the profit activity of a company. Now we want to discuss the relationship between debt and financial leverage and use the ratios to analyze the firm's debt, specifically debt to assets, debt to equity. And we want to use ratios to analyze the firm's profitability and its market value. Market value relates to how valuable the company is within its stock market. And we can use a summary of financial ratios to get an idea of how a company is doing within year over year and within their industry. Now, we have to start out, at the beginning of the story, we start out at GAAP, which is the generally accepted accounting principles, which are set up and authorized by FASB, the Financial Accounting Standards Board. Now, this body who creates the GAAP, they're looking to create a unified and consistent accounting guidelines for companies to put together their financial reports. So all financial reports have a similarity in how they're developed, how they're calculated, and the record keeping to put the numbers together, which is very handy because it makes it comparable between companies and also comparable between quarters and years within the same company. In the early 2000s, we had a lot of conflicts between auditing companies and companies as far as preparing reports and analyzing and recommending stocks. There was conflicts of interest between corporations and their auditing bodies. And sometimes corporations were also doing joint ventures with the same companies that were auditing them, hence the conflict of conflicts. Also, a lot of public companies may be doing business with companies that are actually recommending consumers to buy or sell their stock. So you can see the pressure. If I'm doing business with a company and I'm also analyzing and putting recommendations on their stock, there's going to be a pressure for me to recommend their stock or put a valuation on a stock that would higher than it's normally worth. And a lot of that happened in up to 2002, and then the Sarbanes-Oxley was passed to put a better control on this type of activity. And they want to protect the interests of investors and the public as far as information becoming fair and independent and the auditing reports being accurate. Now, the public corporations with more than 5 million assets and more than 500 stockholders are required by the SEC, Securities and Exchange Commission, to file their annual reports, to provide stockholders with annual stockholder reports to summarize how the firm's financial activity occurred during the year. Now, in a global focus, there are international financial reporting standards and International Accounting Standards Board, which help to set a guideline and a regularity on financials for companies who are more international. So it's not uncommon that a company may put their books to according to GAAP, but they're also going to look maybe if they have a significant amount of shareholders outside the country that their main record keeping is produced, they may want to also have international financial meet the international financial reporting standards as well. So in the United States, public companies are required to report financial statements using GAAP, which requires more detail than the international financial reporting standards. So GAAP is actually the gold standard, so it's easier for them to backtrack and meet the international standards if they're meeting GAAP. In fact, a lot of foreign companies will just go ahead and meet the GAAP standards so their stocks can more easily trade on American exchanges. All right. So we focus on ethics. Ethics plays a big part in accounting and finance. So when we talk about earnings reports, do we take them at face value? So near the end of each quarter, companies have to unveil their quarterly performance. And firms want to beat their estimates and they want to see their share price jump. So they manage their profits in a way that helps to minimize missing their estimates and maximize making or exceeding their estimates. So if you miss your estimates in profits or sales, your stock tends to suffer big declines. And the practice of manipulating earnings to make sure you don't miss your earnings targets is what got a lot of companies into trouble, as they were too aggressively managed earnings, leading them to fraudulent behavior. So if you do it in a way that's legal and is appropriate according to GAAP, then we'd say that you're just managing your earnings, not manipulating them illegally or fraudulently. So financial managers are tempted to manage earnings to make sure that they meet their estimates and their goals of profits and revenues for each quarter. So is it unethical for managers to manage their earnings? I believe that if they're going to manage their earnings in a way that's fraudulent or misleading, that is unethical. But if they're managing their earnings as far as the timing of their sales and what would be legal under GAAP, I think it's okay for them to manage their earnings and to have sort of reserves to better meet investors' expectations, as long as they don't mislead them. So there are four key elements, or four key financial statements, and the first one that's very important, especially to finance, is the income statement. So the income statement is sort of like your personal paycheck. So if you ever had a paycheck and you look at your paycheck and you have your gross pay, and then taxes are taken out, and maybe 401k is taken out, and health insurance is taken out, and FICA is taken out, then at the end of that you have your net pay. And it's very similar for an income statement for a company. So it provides a summary of the operating results for a specific period. It could be a quarter or year. They are prepared quarterly for reporting purposes, but they're also prepared annually. They can be computed daily or monthly, depending on how the management wants to view them. Here is a basic income statement, and what we look at here, if you look at this income statement, we like to see year over year. Much like your report card, you want to see yourself improving in your grade, point average, maybe going from a B average to a B plus, then to an A minus. We want to see companies do the same thing. So we want to see growth in sales, which we have here. We want to see growth in gross profits, which we have here. We want to see growth in operating profits, which we have here. And we want to see a reduction in operating expenses, which we don't have here. But that's to be expected. If the revenues are growing, operational expenses are expected to grow as well. We just don't want them to grow as fast, and we want to have higher operating profits. If we manage our interest expenses and taxes properly, we want to see an increase in net profits. And you have our net profits before tax and our net profits after tax, and then we can use our net profits to calculate our earnings per share. So basically we start out at revenues and we pick away at that number till we get the bottom net income number. And this is very important, and we want to see an improvement in our revenues and our profits in our income statement year over year. Just the same thing in a Zoom simulation. Every year, which is around, you want to increase your profit margin percentages, you want to increase your total profits, gross, operational, and net, and you want to increase your revenues if you want investors to like you, and if you want analysts to score your financial ratios higher, and if you want people to buy your stock. Okay. Now, if you had a personal financial example, it would look at your salary less any interest received on the, say, savings accounts or dividends received on investments, and you'd have your total income. And then you would just subtract away your expenses: mortgage, auto loan, utilities, home repairs, food, car expense, car insurance, healthcare, clothes, insurance, taxes, entertainment, tuition, personal items, to get to your total expenses, and what's left over is your cash surplus or deficit. And you'll notice that in Zoom simulation, at the bottom of your pro forma financial statement, you'll see cash surplus or deficit. So we're really looking at the revenue, the money you bring in from your sales, less all your expenses for the year. And you could do this as more of a personal example that hopefully you can relate to. And before was more, the previous slide, this slide was more of a corporate example. Now, what you should do is, after you run a few practice rounds, you run a round in the team competition, analyze your financial statement. See how you've improved year over year. If there's certain areas where you haven't improved year over year, you need to investigate that and figure out how to improve it. Okay, let's move on to the balance sheet. Now, the balance sheet is a summary of the firm's financial position at any given time. It's sort of like you taking a piece of paper down and writing down on today, writing down all the assets you have, and then writing down all your liabilities to figure out where you stand. So it's only good for one point in time. And so you're looking at what you own and how much of it's financed and how much of it's owned by your own money. So you're looking at your ownership versus your liabilities, or your equity versus your liabilities. And again, what we want to look at here is assets. So we'll look at assets first. This is the first part of the balance sheet, is assets. And we go from the most liquid to the least liquid generally, or the most current to the longer term assets. So the first section is current assets. We have cash, marketable securities, and accounts receivable, and inventories. Cash is cash, we know what that is. Marketable securities are short-term investments. Accounts receivable is money that we lent out to people that they owe us, so it is a asset, but we haven't typically been paid for that yet, but we're looking to receive that at some point. And an inventory is the money we have in materials that we purchased. And what we're looking for here is that, current assets, we'd like current assets to grow along with the company, but not too fast. It has to be proportional to the sales growth. Okay, so that would be our total current assets. Then we look at long-term assets, building and equipment, machinery, furniture and fixtures, vehicles, other. And then we get our total fixed assets, less depreciation. So fixed assets can depreciate. Buildings and autos and computers depreciate, and we're allowed to effectively express how much our assets are truly worth. We're allowed to depreciate them so they show the correct value. So if we owned a fleet of 100 cars and they're 5 years old, we wouldn't want to show them the value of the original purchase. We want to show them at what their resale value would be today, and that's what depreciation helps us to keep in line. So our net fixed assets, add our assets together, net fixed, and current assets, we add them together and we get our total assets. Now we move on to liabilities. So we look at accounts payable, money we owe other people. Notes payable, which is sort of like bank loans or short-term debt we owe other people. Accruals, which is money that we've accrued, means we've accumulated but we haven't paid yet. That could be something like payrolls. So we have a bunch of payrolls we owe, we haven't paid it yet, but we have the money in the account. So it's a liability. Well, let me state that again. We owe this much in salaries, but we haven't paid it yet, so it's a liability. Once we pay our salaries, and if it was a salary accrual, then it would be zero. So this is basically money we owe. So total liabilities would be 620. This is in the millions. This is 620,000. This is in the thousands. And so we look at a long-term debt, including financial leases, and then we get our total liabilities. Then we look at preferred and common stock. And together those become our paid in excess of par capital stock. So par is sort of our starting position, and money we raise through issuing preferred or common stock gets into our equity pool. And then we have retained earnings, money that the company has made that we've kept, and together they become our shareholders' equity. So our shareholders' equity and a liability together becomes our total liability and shareholders' equity. So you see this 3597? That's the same as assets. So assets have to match our total liability and shareholders' equities. And the reason they match is because anytime we accumulate assets, we generally use equity and liabilities to pay for them. So that's how the balance sheet stays in balance. Now, a personal balance sheet, and this is more what a balance sheet usually looks like. Assets on the left, liabilities and equity, sometimes called net worth, on the right. So we look at this together and we see. So this was typical person, or this is Jan and John Smith. They have, cash, checking accounts, savings accounts, money markets, so total liquid assets, stocks and bonds, mutual funds, retirement funds, total investments, real estate, cars, household furniture, jewelry. So this is their total personal property, and this is their total assets if you take their personal property and you add it to their investments and liquid assets. They have $147,000 in assets. Now, in liability, they have credit cards, utility bills, medical bills, other liabilities, real estate, mortgage, auto loans, educational loans, personal loans, furniture loans. So the total liability is $105,000. The net worth is $41,000, means that's the money they have in equity. Or for the total value of their assets, they have $41,000 that they paid into it or paid off, and $105,000 in debt. So together that becomes our total liabilities and net worth. And you see how they have to balance? Very important. If a balance sheet doesn't balance, it's not being prepared accurately. Now, a statement of retained earnings, this is what reconciles the net income earned during the year and any cash dividends paid, or changes in returned earnings from the start of the period to the end of that year. So basically it works like this. A company makes money and it wants to retain that money. So if it has net profits, they can either pay it out as dividends or retain it as earnings, or both. So together, retained earnings and paid out dividends are going to be your net profit. And we add that, it accumulates. So we keep adding that to last year's retained earnings. So if our retained earnings started at 1,012 and our net profits were 231, we paid out 10 in preferred stock and 98 in common stock. It means our total dividends paid are 108,000. So we take our 231 and we want to add that to our retained earnings. So that gives us 1,243. Subtract 108 and we get 135, and that would be our retained earnings. So we're adding the excess, the money above. We take our net profits, subtract out our dividends, and we add that to our retained earnings to get our new retained earnings. So it's sort of like, think of it like a bank account. Whatever money you earn that you put in your savings account, when we get to the next year, that savings account doesn't go back to zero, and then the new money you earn in the next year you add to the savings account. So retained earnings is like sort of the money the company has earned that they haven't paid out to dividends to investors. Now, the statement of cash flow is another financial statement when we look at the movement of cash in the company. And it provides a summary of operating, investment, and financial cash flows that we use to reconcile the cash activity for the quarter or the year. So it provides an insight into the company's investments, the money they raise in the financing, and the operational activities of profits or losses the company makes. So together with the income statement and balance sheet, they give a more complete picture of the company's financial performance. And the cash flow statement ties to the income and balance sheet. It takes elements of both. Now here's a cash flow statement for a company. And we look at net profit after taxes. So this is the net profit of a company. We have our depreciation. So depreciation is a non-cash charge. So if we have depreciation on the income statement, we add it back to the cash flow statement. So these are going to be, income, net profits increases cash flow. Depreciation, when we add it back, increases cash flow. Increase in accounts receivable. So if accounts receivable has increased, that decreases cash flow. A decrease in inventory will increase cash flow. An increase in accounts payable will increase cash flow. And an increase in accruals will increase cash flow. So cash flow provided by operating activities is $500,000. So for any of these, receivables, inventories, payables, accruals, you have to understand that if you're borrowing money if you're lending money to people, that's decreasing your cash. If you're buying more inventory, it's decreasing your cash. If you're decreasing your inventory, it's increasing your cash. So you have to understand how cash flows into or out of inventories, payables, receivables, and accruals to understand how it affects cash flow. So when money is being loaned or spent, cash flow decreases. When money is being borrowed or saved, cash flow increases. So that would be from your operations. This is the most important category because we want to have a positive cash flow from operations, means the business is healthy. Now, investment activities means that we could buy some more fixed assets. So if we buy fixed assets, it's going to reduce our cash flow. If we sell fixed assets, it's going to increase our cash flow. Okay. Now, cash flow from finance activity is borrowing money. So if we pay back our loans, this cash flow decreases as we pay back loans. But if we increase our loans, like here we're increasing long-term debt, that's going to increase our cash flow. Just like when you borrow against your credit card, take a cash advance against your credit card, you're going to increase your cash position because you're increasing your debt position. Okay, so if you pay any dividends, that's going to decrease your cash because you're paying dividends. Any cash provided by financing activities, we add these together to calculate the cash provided by financing activities. Just like we would add these accounts here to cash provided by investment activities, and here cash provided by operational activities. So we add up operational, investment, and financing activities to give us our net increase or decrease in cash. And cash flow here is increasing, And the majority of this in total increase in cash flow is coming from operations, which means this is a very good cash flow statement to see, because we're investing in the company and we're paying down debt and paying dividends, but we still have positive cash flow because our operations are so strong. Okay, so in consolidated international financial statements, we have this FASB 52, which mandates that U.S. companies translate their foreign currency denominated assets and liabilities into dollars for consolidation to the parent company's financial statements. So if a company has assets overseas in foreign currencies, they have to use the exchange rates to bring them into line with U.S. dollars, basically translate the value into U.S. dollars and create a consolidated set of financial statements. And you can use the currency rate translation method. It's a technique used by U.S.-based companies to translate foreign currency denominated assets and liabilities into dollars for the consolidated financial statements, using a year-end currency rate rather than a daily currency rate. And this way, revenues and expenses are treated in a similar fashion and a similar currency rate. Now, on the other hand, equity accounts are translated into dollars using exchange rates that prevail when the parent company's equity investments were made. So those equity accounts will use the exchange rates on the day of the transactions, and retained earnings are adjusted to reflect the year's operating profits or losses. Okay, so let's move into the next big section of this chapter, which is using financial ratios. So who is interested in financial ratios? Well, first let's define what a financial ratio is. It's a method of calculating and interpreting. Financial ratio is anything using the financial statements to put together a measure of performance. A ratio analysis is what I was starting to explain before, involves the method of calculating these financial ratios to analyze and monitor a firm's performance. So potential shareholders and stakeholders would be interested in a firm's financial ratios. Creditors who may want to lend the company money will be interested in the financial ratios, and management would be also interested in financial ratios, as well as owners. So a lot of people are interested in financial ratios, and so I guess it's one of the reasons in the Zoom simulation the financial ratios are so closely reviewed for the overview points. So your year-over-year performance and I think at least 10 or more financial ratios are considered when you're looking at your evaluation of your company's performance. And that's how it's done in the real world. In the real world, you look at a company's performance, and their competitors will make it harder for a company to do well because the competition is fierce and very tough. It makes it harder for a company to earn profits and increase revenues, but companies are always measured by their performance of their financial ratios year over year. Now, you could look at industry averages as a financial ratios to compare how a company is doing compared to their competitors, but generally you want to see how the company is performing year over year. Now, you could do a cross-sectional analysis, and this is where you're comparing your company to other companies. So the financial ratios, at the same point in time, how is your company's profit margins compared to similar competitors in your industry? And those industry averages is what you could use to see if you're doing better or worse than your competitors. And you can use benchmarking, which is a cross-sectional analysis where you look at the financial values of your company compared to competitors in a similar group, and you want to do better than them. So an industry averages are very common for using this cross-sectional analysis benchmarking. So let's look at this company, this manufacturing company. So we calculated the inventory turnover for 2015, and the average inventory turnovers were as follows. So the turnover for 2015 for the company was 14.8, and the industry was 9.7. So what does that mean? It means that this manufacturing company turns their inventory more aggressively than the industry, and that's good because higher inventory turns are better. It means you're more efficient with your inventory. Here is an example of financial ratios and select items for an industry and their median values. So let's look at, here's the industry. So we have computers, Dell and Hewlett Packard. We have building materials, Lowe's and Home Depot, grocery stores, Whole Foods and Kroger, and merchandising stores, Sears and Walmart. So here are the current ratios for everybody, the quick ratios, inventory turnover, average collection period, total asset turnover, debt ratios, profit margins, return on assets, return on common equity. So this would basically lay out at the bottom. Here is the industry average. So we want to see, is Dell doing better than the industry average? And if they're not doing better, then there's a problem. Okay, we'll talk more about this later, but I think it's important first to go over all of these financial ratios to explain what they mean and the significance of them. Okay, so before we go over the actual financial ratios, let's talk about a time series analysis. So this is an evaluation of the firm's financial performance over time, generally a year-over-year or quarter-over-quarter view. And again, this is like your academic record. If you're analyzing your academic record, you want to see that semester over semester, your grade point average is increasing every semester. So you want to compare your current performance to your past performance, and you want to see that you're improving and making progress. So you can see these trends in a multi-year comparison and plot them on charts. Because you always want companies to move forward and improve. Just like in a Zoom simulation, if you look at the industry charts, you'll see charts listing sales, revenues, profits, earnings per share, and you want to see that your company is improving every year. The trajectory is moving higher on the line chart, especially compared to your peers. So cross-sectional time analysis or time series analysis will help you see how your company is improving through time. And hopefully it's improving at a steeper rate than your competitors. But time series analysis is really just looking at yourself, your company, through a period of time, either measuring quarters or years. So here's an example of this one company, and we're looking at average collection period in days. And so the average collection period in days, the smaller amount, the quicker you collect, the better. So in this particular case, they went from collecting in 40 days to collecting in 60 days, which is bad, where the industry has decreased or maintained. It did increase at the end, but the industry is far below the company here. So their collection period is getting worse, and it's outstripping the industry. So that would be a time series analysis, usually expressed by charts. And you could see this in the Zoom simulation if you look at the individual or industry charts. We'll plot your time series of evaluation. Let me just pause here for a second. Okay, so using financial ratios and caution about using financial ratio. Well, financial ratios are a very useful tool and give you a lot of insights into a company. However, if a financial ratio reveals a very large deviation from what you normally see, that could indicate a big problem. A single ratio doesn't necessarily provide enough information to judge the overall performance of a company. You have to look at them together. So you have to look at a set of financial ratios together in unison to get an idea if the company's sick or not, or performing well. Now the ratios being compared need to be calculated using financial statements dated at the same point in time during the same year. So you have to get all the information from a set of financial statements that are of the same time period. So you can't use last quarter's financial statements with information from this quarter's financial statements. They have to all be at the same time. And the financial statements should be audited, officially audited, and signed off by the chief financial officer. And the financial data being compared should have been developed in the same way. And results can be distorted by inflation. So if a company has increased revenues, it may be, say the company increased their revenues by 2%. It may just be the fact that they raised prices by 2% to compensate for inflation. So inflation, when you're looking at a company through, say, a 10-year period, you have to really account for inflation to make the numbers comparable, especially when we're talking, profits and revenues. Okay. So let's illustrate an example of using financial ratios, and we're going to look at Bartlett company's income statement and balance sheet. So this table 3.1 and 3.2. So the current ratio, so let's talk about the current ratio. It measures the ability of a firm to meet its short-term obligations. So we look at our current assets divided by current liabilities. The higher this number, the better. That means you want to have more current assets than current liabilities, because that gives you ability to pay for your current liabilities with your current assets. So again, you want to see a company having a higher current ratio and having more current assets than current liabilities. Okay. Now, when we look at liquidity needs, this is how much cash a company would need and how liquid they are. So large companies have a nice line of credit that they can draw additional funds from. So their liquidity is, they're a little bit flexible in their liquidity because they have the ability for them to raise short-term funds pretty easily. Where smaller companies may not have the same access to credit or the same amount of credit, so they tend to be a little bit, need to be a little bit more liquid to compensate for the fact that they can't easily raise money quickly, small companies. Now in your personal finance, you would want to look at, your total liquid assets by your total current debt. And again, that would be, just think of this, how much cash do you have in the bank versus how much do you owe on your credit cards? And that would be sort of a liquidity ratio that you could put together as a personal ratio. And you want to make sure that you have more current assets than current liabilities. So let's talk about sometimes it's called the quick ratio or the acid test ratio. And this is the current ratio, except we subtract out inventory. And the reason we subtract out inventory is because it's not a very liquid, it's the least liquid of the current assets. So a lot of inventory is difficult to sell quickly. So we want to take the inventory out of the current assets and then look at this quick ratio again to see how things measure when we're talking about the cash, mostly cash versus your current liabilities, to see how this number looks without inventory. And again, the higher this number, the better. And you can see that at 1.51, that's going to be lower than their 1.97 of the current ratio. So if a company has inventory, their quick ratio will always be lower than their current ratio. And you measure by how much lower is how you kind of measure how beneficial it is. Okay, so importance of inventories. If we look at this table, we have Dell, Home Depot, and Lowe's. And we look at their quick ratio and their current ratio. And we see here that Dell has the least amount of inventory because they have the least amount of change between their current and quick. Where Lowe's has the biggest change, means that Lowe's has the most inventory. So Dell is the most efficient in managing their inventory, and that's why they have the least amount of loss going from current to quick ratio, where Home Depot and Lowe's are holding a lot of inventory, which makes sense because Dell employs a just-in-time inventory, so they don't keep a lot of inventory on hand. And Home Depot and Lowe's have to stock a lot of inventory on the shelves, and that's why it's important to see what their quick ratio looks like after you take away from their inventories. Now, inventory turnover measures the activity of a firm's inventory. So we look at the cost of goods sold divided by inventory to get the current inventory turnover. So the cost of goods sold is really showing me how much, the cost of goods sold is sales minus the gross profit margin will give you the cost of goods sold. So you look at you look at the revenues and you look at the cost for those revenues and you divide by inventory. And again, the higher this number, the better. So we're doing a relationship between the goods sold, the cost of the goods sold, divided by the current inventory you're holding, and it shows that our inventory turns are 7. So we have 7 times the amount of cost of goods sold that we do have inventory. And think of it this way: if the more inventory, think of an example of cereal. So if you eat, say, 52 boxes of cereal a year, and you only have 1 box in inventory in your house, then you have a inventory turn of 52, which is very high, but it's very efficient. If you had an inventory turn of 1, that would mean that you eat 52 boxes of cereal a year, and you have 52 boxes of cereal currently in your kitchen. So you see how a low inventory turn of 1 would be inefficient for a company to have all that money. Can you imagine if you went to the supermarket and bought 52 boxes of cereal, how much that would cost? And then you had to stock that in your kitchen. So that would be a lot of cereal to have around. You might have to buy extra storage. You could have spoilage. You could have theft. So that's why it's good that companies keep a smaller, more efficient inventory, because they don't tie up as much cash in inventory and they don't have as much risk as inventory being on hand. So one thing that could happen, if you have a year's worth of cereal, maybe some of that cereal expires. So that's why companies want to be more efficient with inventory, and that's why we look at inventory turnover as a measure. Now we have the average age of inventory, which is particularly important for manufacturers who have expiration dates on their inventories. Now the average age of inventory would be 365 days divided by the inventory turnover. So if we take our 365 days, we divide by the inventory turnover number that we just calculated, we get our average days of inventory on hand. So here we have 50 days of inventory. So we want to keep this number as low as possible. So this is one of the ratios where we like this number to be lower because it means we're more efficient with our inventories. So it's sort of like the cereal boxes. Do you want to have how many days of cereal boxes do you want to have on hand? Okay. Now the average collection period, this is another very useful ratio, and what we look at here is the period, the average amount of time needed to collect your accounts receivable. So we take accounts receivable divided by average daily sales per day. Now to calculate the average daily sales per day, we have to take the annual sales and divide by 365. So we take our accounts receivable, we take our sales divided by 365, and that gives us $8,422 of sales per day. So if we take our accounts receivable divided by our sales per day, we get the amount of days that it takes us to collect our money. So the lower this number, the better, because you'd like to collect your money in 10 days rather than 60 days, right? Makes sense. So if you lend money to somebody, the shorter period of time it takes for you to collect it, the better. And it's the same thing. It's one of the very rare ratios where we like a lower number here because it means we're collecting our money faster. Now, if you're a company, a lot of businesses who do business with other businesses may have to lend credit. So if you're trying to build materials and merchandise, you may have to get store credit to, and we want to know some industries, it depends on the industry you are. In some industries, if you're buying a lot of materials, generally you're going to buy them on credit. So if you're in the industry that are selling things that other companies are going to want credit for, you may have to extend a lot of credit, which means it's important for you to collect that money back at a certain period of time. So average collection. We can also look at average payment period. So this is taking accounts payable now and dividing it by the average purchases per day. So we take accounts payable divided by annual purchases divided by 365. So if we assume that Bartlett Company's purchases are valued at 70% of its cost of goods sold, and that basically means that the cost of goods sold makes up 70% purchases, 30% labor. So a cost of goods sold, the two ingredients in cost of goods sold is materials and labor. So here we assume that 70% of the cost of goods sold is materials. So that's why we take 70% of the annual purchases divided by 365, and then we can take the accounts payable divided by 4,000, and we get our average payment period. So this number, it takes us 100 days to pay our accounts payable, and the longer we delay payment, the more money, the more cash we have. So we like this number to be bigger, but we definitely don't like it to be above 90 days because we could have a bad reputation for not paying on a timely basis. Okay, so let's look at total asset turnover. And this is something from the Zoom simulation. A lot of these, not all of these ratios, but all of these ratios are in the Zoom simulation. This looks like it's sales in relationship to total assets. So if we have sales of 3 million and assets of 3.5 million, we have a total turnover, asset turnover of less than 1. Which is not ideal. So what we want is our assets to generate more sales. So think of yourself, if you were an ice cream company and you had, say you were like a Red Mango and you had all these big expensive soft serve machines, you may have a situation like this where your sales are 3 million and your assets are 3.5 million and you have a total asset turnover of less than 1. Now let's say you're just a Haagen-Dazs that just uses tubs of ice cream and doesn't have soft serve machines. Now, you may have a situation where your sales are 3 million, but your assets are only 1 million, giving you a total asset turnover of 3, which is much better. So just like in the Zoom simulation, you don't want to buy excessive factories if you don't need them. You don't want to have leftover inventory of cars you didn't sell. These are all things that are going to inflate your assets and reduce your total asset turnover. That's why you want your forecasting to be accurate, so you don't have a lot of leftover inventory, because that's going to increase your total assets, because inventory is an asset, and reduce your total asset turnover. And you also don't want to buy factories that you don't need, or buy a factory that you're only going to use. The factory has a capacity to make 1,000 vehicles in the simulation. And if you buy a factory just to make 50 vehicles, your capacity utilization is very low. So you have this big, expensive $10 million asset really not producing a lot of sales. And this is another reason your total asset turnover could go lower. Okay, so you want to sell it fast. So if you make something, you want to sell it fast, because you want to turn your product into cash as fast as possible, and you want to minimize your inventories, and you want to sell. So ideally, for a grocery store, the best thing it could hope for is in the morning, stock the grocery store with everything it's going to sell for that day. So if they knew exactly what they were going to sell for that day, then they stocked the exact amount of what they'd sell that day. So they open up with an inventory and they close with everything being sold. That's probably the best of all worlds you could do. And the next day, a shipment comes to replace everything that's been sold. So you do it again. So you would have an inventory turnover of 365. Now, this is very difficult for any store to do, and that's why most stores have a bigger stock than, they want to keep enough in stock to meet all the demand and not lose out, because if a customer comes and there's no milk or eggs, they may not come back again, or they may have to go and buy those from a competitor. So thus you're losing sales. So sometimes it's advantageous to keep a bigger inventory in certain businesses to make sure that you have enough product to sell to meet your customers' demands. So in this example, Patty, she's incorporated a new business. She needs an initial investment of $50,000, and she's considering a no debt plan under which she would invest the full amount without borrowing. The second option is the debt plan, which involves investing $25,000 and balancing the remainder at 12%. So if she expects $30,000 in sales and $18,000 operating expenses and has a tax rate of 40%, this is sort of what her plans would look like. So in the no debt plan, she would have her current assets, fixed assets, and total assets, the same in both plans. But here, she'd have an interest charge. So interests and equity, actually, there's an interest charge, but the total debt is she's borrowing $25,000 and putting $25,000 of her money in. So together, her liability and equity is $50,000. Here, she's borrowing nothing and putting the full $50,000 of her money into the business, and her liabilities and equity are the same, $50,000. Let's look how that works out in the income statement. If you both have the same sales and the same operating expenses and the same operating profits, except when you get to the interest expense. There's no interest expense here, but there's an interest expense for the debt plan. So that reduces the net profit. So you have $12,000 net profits here, $9,000 here. So your taxes are higher here because you can't deduct, you're not deducting your interest from your income, but your overall net profits are $7,200. For here, you're going to pay less in taxes because your income's lower because your interest is deductible. So your net profits also totally lower at 5.4. But if we look at our return on equity, here our equity, our profits are $7,200 and our equity is $50,000 because we put $50,000 into the business. So our return on equity is only 14%. But here our equity is only $25,000 because we only took $25,000 to put into this investment. Our return is higher, even though our return on equity is higher, even though our total return is lower. Since only $25,000 of our own money is in this investment, our return on that money is higher. So think about it. Say these were Subway locations. So in this plan, you only have $50,000. In this plan, you can only get one Subway location, and you're investing $50,000 to buy that one Subway location. Maybe in this plan, you have enough money to invest in, this could be one Subway location, but you can make a second Subway location with the other $25,000. So you're borrowing a total of $50,000, investing a total of $50,000, and that way you would still have the same return on equity, but you're going to be doubling this. If you have two locations, this would just be one location, you make $5,400, but two locations, you make $10,800. You'd be making more because the return on equity is higher. Okay, let's look at the debt ratios. So total liabilities divided by total assets tells you how much your assets are financed by debt. So here, the total liabilities are $1.6 million total assets are 3.5 million, or practically 3.6. So that gives you a debt to asset ratio of 45%, which means that 45% of your assets are financed by debt. So the lower this number, generally the better. It means you're using less debt to finance your assets. Now, if we look at debt to equity, we want to see the relationship to how much liabilities in your company are financed by equity. So we're comparing debt to equity. So here we have a debt of 1.6 million, equity of 1.7. So 97% of your equity is comparable to debt. So it's sort of a 1-for-1 almost. So this company's, I think 50% debt, 50% equity, and it's a close to 1-to-1% ratio. And this is important to understand how much equity do you have compared to how much debt you have. And you generally do want to have something close to parity on this. Okay. Times interest earn ratio. Here we're looking at how much, we want to look at the ability to pay your interest. How much times your earnings compared to the interest you owe. So in this particular company, they owe their earnings before interest and tax of $418,000, and if we divide that by their taxes, we get a times interest earn ratio of 4.49. So it measures the ability to pay your interest payments. So remember, EBIT is the same as operating profits in the income statement. So if we imply, a lot of times when I look at times interest earn ratio, I also think of earnings divided by the interest I owe on my loans. Okay, so let's look at a fixed payment coverage ratio. And here we could look at earnings before interest and taxes plus any lease payments. And we're going to divide by interest plus lease payments plus principal payments plus deferred stock dividends times 1 divided by 1 minus the tax rate. So this is by far the most complex formula we've had, but it's still a pretty easy formula. Once you have these variables laid out using order of operations, it's really not that hard to calculate. But we're looking at the fixed payment cover ratio. So it looks at our earnings in relationship to the fixed payments that we have to make. And again, the higher this number, the better. Okay, so if we look at a common size, what we call a common size income statement, we have our year over year, and we put things in percentages. So we keep the sales revenue at the same 100%, and then we look at the gross profit margin, and if 2015 is lower than 2014, we say it's worse. If our cost of goods sold is higher, we say it's worse. We look at this, the selling expense has gone down, so that's better. And general administration expenses have gone up, so that's worse. Our lease expenses have gone down, so that's better. And depreciation expense has gone down, so that's better. Our total operating expense has gone down, so that's better. Our operating profit margin has gone up, that's better. And our interest expense has gone down, so that's better. Our net profit before tax has gone up, so that's better. However, our total taxes have increased, so that's worse. But that's also something you have to look in relationship as a percentage to sales. So it's not, it depends on how much worse. Okay. In this case, if sales are the same, it's worse. Net profit after taxes is better because it increased. Less preferred dividends, we're paying less than preferred dividends, so that's better. And the net profit margin percentage has increased, so that's better. So here we're looking at, again, a year-over-year improvement on what we call a common size financial statement. Okay, so this is the profitability ratios, I think, are the most important ratios to look at as an analyst and also to help you with the Zoom simulation. Now, if you want to do well in the Zoom simulation, and if you want to do well as a financial manager, you have to increase your gross profit margins. This is what every company does. Every company is constantly looking to reduce the cost of goods sold to increase their gross profits. And if you increase your gross profits, your gross profit margin goes up. And it's a very simple formula. Sales minus cost of goods sold, which is, again, labor and materials in the products you sell, divided by sales gives you a gross margin percentage. The higher, the better. So for example, in the Zoom simulation, you start off at 40% average gross profit margins. If that number goes down when you complete the first year, you will not do well in the simulation. And if that number continues to go down, you continue to do poorly in the simulation. So you want to get that profit margin percentage up at least by 5 percentage points every round. And you want to end up, if you start off at 40%, hopefully you're ending up at 60, 65% by the end of the simulation. Now, operating profit margins is the next important profit margin to look at, and we take the operating profits divided by sales. So operating profits, after you take out cost of goods sold and operating business expenses of operating basically the business, you get your operating profits, or EBIT. Divide that by sales, and you get your operating profit margin, which is almost always lower than the gross profit margin. I would say 99.9% of the time it will be lower. Now, if you overspend in advertising, you may wind up shrinking your operational profit margin to too much. So you have to make sure that the amount that you're advertising makes sense for what you're trying to sell. So if you are greatly expanding your advertising budget faster than you're expanding your profits, your operational profit margins will go down. And when your profit margins go down, it affects 5 or 6 other variables, 5 or 6 other ratios in your overview points that will also go down in tandem with your profit margins. Now, your net profit margin, after you take out interest and taxes, you have your net profit margin, or earnings available to common shareholders, divided by sales. So again, this is going to be the smallest of the profit margins. But again, here too, if you borrow too much money and pay too much interest on the money that you borrowed, you're going to have trouble increasing your net profit margins. And if you don't increase your net profit margins, your return on assets, your return on equity, your return on total asset turnover, all these variables, these ratios will be lower as well. So you want to really make sure that you borrow money when you need to that's going to help you increase your profits in your business, but you're not borrowing money that's not being used effectively, because that's going to lower your net profit margin. So earnings per share is simply the earnings available to common shareholders divided by the number of outstanding shares. So if you had earnings of 221,000 divided by number of outstanding shares of 76,000, you have earnings per share of $2.90 per share, which is, and that number needs to go up every year. Your earnings per share has to go up every year. Now, if companies issue new shares of stock, so in the Zoom simulation, if you're borrowing or issuing new equity and new shares of stock, your number of outstanding shares will increase, which will make your earnings per share decrease. So you may have a situation when your profits and revenues increase, but your earnings per share decrease because you issued too much stock. So when you have in a position of making enough profits, you want to start buying back your shares of stock to increase your earnings per share. And that's why you hear a lot of companies announcing these stock buyback programs, because inside these stock buyback programs, companies are trying to reduce the amount of outstanding shares to increase their earnings per share. Okay, let's look at return on total assets, ROA. So what we're looking here is we're looking to measure earnings available to common shareholders divided by total assets. So again, earnings available to common shareholders is basically your net income. And if we divide that by your assets, you get the return on assets. So you look at your assets as one number. I have $3.6 million in assets that generated $221,000 of profit. That's a 6% return. So what you want to do next year is, if you can increase your profits, you're going to be increasing your return on assets. You want your assets to be as effective as possible. So for a company, if they have some big assets like factories, in order to increase their return, they should operate them not 8 hours a day, but 24 hours a day. So they could get even more product and get their assets to generate more products that they could sell and earn more earnings and get a higher return on their assets. Or they want to replace expensive assets, sell them off with maybe cheaper assets or more inexpensive assets or more efficient assets to increase the return. So say you had a pizza store and you had a pizza oven that could only make 3 pizzas at a time, but yet you have demand for making up to 10 pizzas at the time is what you could sell, but you're giving up sales because you don't have a big enough capacity of your oven. So investing in a bigger oven will cost more money and increase the value of your assets, but it'll also triple your sales. So you have to look at that relationship. Return on equity is looking at your earnings compared to your equity, or your net profits to your equity. So your equity is really the money that you put into the company. So you want to see what type of return am I getting for the money I'm putting into the company. And the more money you put into the company, and if your earnings are the same, and you're putting more money into your company, paying down your debt, you'll see your return on equity decrease. Which if you're analyzing it and you're seeing that the return on equity is decreasing because I'm increasing the size of my equity pool, that's not that bad. However, if your return on equity is decreasing because your earnings are decreasing, that would be a bad return on equity. So you have to look at return on equity closely to see is this number decreasing because my earnings are decreasing, or is it decreasing because my equity is increasing? If your equity is increasing, that's not a bad result. But if your profits are decreasing, that would be a bad result. Price to earnings, what's commonly known as a PE ratio. So these are market ratios. So we look at how many times the business is trading in comparison to its earnings. So the price of the business divided by the earnings for the business. So for stocks, we look at the stock price per share divided by the earnings per share. So if we have a stock price of $32 and earnings of 2.90, we're going to have about 11 PE ratio. So the stock price here is 11 times earnings. So if you take earnings per share of $2.90 times it by 11, you get the $32. So it's trading at 11 times earnings. So basically, say you had a business and your business generated $25,000 worth of profits a year, or we could say there's one share in the company and your earnings per share is $25,000, and you're able to sell the business for $250,000, you're selling the business for 10 times earnings. So that's what it's really looking at, the multiple of earnings that your company's valued at. And the higher this number, the more highly valued your company is. So this number can sometimes tell you whether your company is undervalued or overvalued when you look at peers. Okay, we have the market to book ratio, M divided by B, and this is the market price. Market price relates to, that's stock price. So stock price per share divided by book value per share. Now, what is book value per share? It's the common equity divided by the number of outstanding shares. So the book value per share says, if I were to close the business down, how much, say I was to take the business, pay off all my debt, and just be left with my equity. So you take your equity divided by your common stock and you get your book value per share. How much of your stock price is actually book value? Now the book value in relationship to the stock price in relationship to the book gives you an idea of how much your stock price is trading above your book value. So say you had a company that had $10 per share of book value and it's trading at $20. So your market to book ratio would be 2. The stock's trading at 2 times the book value, which is not uncommon. You want, generally companies' stock prices are higher than their book value. So this just gives you an idea of how much, if they're getting to be too close, equal, there could be a problem because generally companies should be trading at least 2 times book value. But again, it depends on the industry. So here we have a book value per share of 1.7 million, and we have 76,000 outstanding shares. Gives us a book value per share of $23 per share. And if the market price, the stock price is $32, the market to book ratio is 1.4, meaning the stock price is 1.4 times the book value. So again, it's a measure of value. It's a measure of market, how much the market is valuing your company above its book value. So the book value is really the lowest price a company should be valued at, because that's the starting point, saying that the book value is saying this is the value of the assets of the company after you pay back your debt, and assuming no value for the business would be the lowest value a company could generally have. So if a company is actually trading below book value, there might be some outstanding problems, such as lawsuits, that are causing that. Okay. So in this slide, which is, look in your book on table 3.8 if you want to see a bigger version of this. I know it's kind of tiny, but here we want to look at the ratios in a year-over-year comparison. Just like in a Zoom simulation, your overview points are year-over-year comparisons. That's how financial analysts measure companies. They look at, your current ratio. Is it improving? So we did improve, but we went down in 2005. However, our quick ratio improved every year, which is good. If we just look at the current ratio, it's okay, but because we take out the inventory, we see that we are making an improvement every year, and we're above the industry average, we're good. So we look at the cross-sectional and the time series. The cross-sectional would be us against the industry, and time series would be how we're doing through time. So for all the ratios, inventory turns are going up, and we're beating the industry, so we're good in all categories here. But collection periods are going up, and we're higher than the industry, so that is poor, because we want low collection periods. And if we look at total asset turnover, we see that our total asset turnover is better than the industry, but we're not improving much in this area. Debt ratios are going up, but we're not that much higher than the industry. We want these to go lower, so they're just okay. If we look at, let's go down to what's really important, these profits. So our profits are moved up from 13 to 14, but moved down to 2015. But we're still beating the industry average, so we're okay in those categories. Not great though. Operating profits have gone down and then 2014, but then gone up in 2015, and we're beating the industry. So we're good in the cross-sectional, okay. In the time series, overall it's good. Net profit margins again went down and then up, but we're beating the industry. And we are improving going up, so that's basically how we want to look at it. How are we doing through time, and how are we doing compared to the industry average? If we look at earnings per share, we see that those, like the profits, have gone down and back up, but we're beating the industry. Return on assets have gone down and back up. Again, same story, beating the industry. And return on equity has gone down and back up, but we are beating the industry. So similar story, all three places there. PE multiple has gone down then up, so we're lower than the industry, which means we might be a little bit more undervalued. So if we're lower than the industry, our PE ratio, our company may be a little bit undervalued compared to the industry, but not by much. And our market to book has gone down then up, but we're still a little bit above the industry, so it's just okay, nothing spectacular. So this is basically how you would analyze, and this you could do with your results of your company in a Zoom simulation. How has your company improved year over year? The industry, your company chart will show you that, and the industry chart will show you how you're comparing to the industry averages. Okay, let's talk about the DuPont system. So the DuPont system is a system of analysis to help dissect the financial statements a little bit more quickly and understand and assess the financial condition of the company. It merges the income statement and balance sheet together into two summary measures of profitability. So the DuPont formula relates to the firm's return on assets and to its return on equity using financial leverage multiplier, FLM, which is the ratio of total assets to common stock equity. So return on assets and return on equity are shown in a series of equations relating them to each other so we can find points of weakness. The basic formula for return on equity, as we know, is net profit margin times total asset turnover. So we could calculate the return on equity by multiplying these two other ratios. So the earnings divided by sales gives us our net profit margin, and sales divided by total assets gives us a total asset turnover, which equals earnings, net profits basically, divided by total assets, which gives us our return on assets. So we covered this formula early in the return on assets, but if you break that out, you can actually see these two variables, net profit margin and total asset turnover, can be multiplied together to get the same result. So this can give us a hint of where the problem is. Is the problem that sales are being reduced, or assets are being increased, or profits are being reduced? So if we look at return on assets as far as net profits multiplied by total asset turnover, we get return on assets is 6.1. Now, if we want to look at return on equity, we could take return on assets and multiply it by the financial leverage multiplier. So return on assets, again, net profits divided by total assets. Remember, earnings available to common stockholders is basically net profits. Divided by total assets is our return on assets. Total assets divided by common equity is our what we call our financial leverage multiplier. How much of our assets are leveraged? By dividing by equity, we can tell the leverage measure. So again, we learned that earnings available to common stockholders divided by common stock equity gives us return on equity. But here are the 4 factors that you can multiply against each other to give us that result as well. So here, return on, we're looking at return on assets and the financial leverage multiplier, we get a return on equity of 12.5%. Now, this is sort of the system. So our net income, these are the variables the variables we take from our net income. These are the variables we take from a profit statement. I'm sorry, this is the variables from the income statement, and these are the variables from the balance sheet. Sorry about that. Now, taking our earnings, dividing it by sales, we get our net profit margin. Taking our sales divided by total assets, we get our total asset turnover. Taking our liabilities plus our shareholders' equity, we get our total liabilities and shareholders' equity, which also equals our total assets. Divide that by our common equity, we get our financial leverage multiplier. Now multiply total return on assets by the leverage multiplier, we get our return on equity. So return on equity is sort of the king on the pyramid of the DuPont system, and return on equity is really, at the end of the day, this is how much money that we're making based on the money we put into the company. So the equity, or the money we put into the company, this is the number we really care about, because this is our return, how much money we're making from the money we put into the company. And if there's a problem, we could look at this versus last year and say, is it return on equity? Return on assets that's the problem because that went down, or is it the financial multiplier because that went up? Is that the issue? The financial multiplier went down. Is that the issue creating a problem with return on equity? So if return on equity was lower and we saw that return on assets were lower, we'd say, okay, it's not the leverage multiplier, it's the assets of the problem. Is it the profit margin or the total assets that's the problem? So the profit margin was the same. In the total assets turnover was larger, we'd say, okay, it's the assets that's the problem. Is it revenues or sales? Is it revenues or assets causing that problem? Meaning, did the assets grow faster than the sales, reducing our total asset turnover, which reduces our return on assets, which reduces our return on equity? If assets were the problem, we look to see, is it because we're increasing current assets or are we increasing net fixed assets? So this is just a way to kind of say, if there's a problem, if our return on equity went down, this is how we could quickly figure out where the problem is. Is it with ROA or FLM? If it's with FLM, is it a problem with assets and liabilities or equity? And if it's assets and liability, is it the liabilities growing too fast or the equity? And if it's the liabilities, is it current or long term? If it was net profit margin, say it was return on assets was a problem and we had a lower net profit margin, was it because the sales decreased or is it because the income decreased? If the income decreased, which was it? A factor of increasing cost of goods sold, increasing operating expense, increasing interest expense, increasing taxes, more preferred dividends. So this DuPont system is just a system we use to try to nail down where the problem is. So we could just look, as an analyst, we'll just look at return on equity. If this is lower, then we'll use this DuPont analysis to figure out where is this originating from? What is the financial item that's creating this problem? And sometimes it can be a combination of lower return on equity and lower financial leverage. Okay, so dissecting the ROA, which I was doing before, we want to examine, both firms, let's see, if we look at table 3.5, which was this previous table, that's 3.2, actually 3.5 from the textbook, we can examine the total asset turnover for Dell and Home Depot. So both firms have assets of 1.6 times a year, and Dell's return on assets is 4.3, Home Depot's is 6.5. Why is Home Depot's higher? The DuPont analysis will tell us. And the answer lies by using the DuPont analysis. And when we use analysis, we can see that Home Depot's net profit margin is 4% compared to Dell's, which is 2.7. So that's why Home Depot's return on assets is significantly higher because they have a better profit margin. Okay, So that's the end of this chapter. So again, what we learned here, we reviewed the common financial statements: income, balance sheet, and statement of cash flows. This is not the first time you should have seen these. This is a review. You should have covered this in financial accounting, or even perhaps in Introduction to Business. So this chapter is sort of a review of these financial statements and why they're important. And we must review them because we need them to generate the financial ratios, because we need to understand what the financial ratios are and how to analyze the financial ratios, especially analyzing them for liquidity and activity. We also have to analyze the financial ratios between debt and leverage. And we want to use the financial ratios to analyze profitability and the market value in the marketplace. And finally, we want to use the DuPont system of analysis to do a complete ratio analysis to figure out if there is a problem, where is it originating. So sort of the DuPont analysis is a detective work to figure out where is the problem occurring so management can address it and fix it. Okay, that's the end of this chapter. Now, at this point, you should go into the homework manager and complete the homework for chapter 3. Also look at the spreadsheet problem for chapter 3. Thank you, and I'll talk to you soon.